when I calculate intrinsic value of a business, when we buy businesses, and whether we're buying all the business or a little piece of a business, I always think we're buying the whole business because that's my approach to it. I look at it and say, what will come out of this business and when? And what you really like, of course, is then to be able to use the money they earn and earn higher returns on it as you go along. Well, intrinsic value is the number that if you were all knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making investment and laying out money now is to get more money later on, right? That's what investing is all about. When we buy, some new machine for Shaw to make carpet, that's what we're thinking about, obviously, and you all learn that in business school. But it's the same thing for a big business. If you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you incidentally. But the question is, was you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference as you get further out. And that is a question of how much cash they're going to give you. It isn't a question of, isn't a question about how many analysts are going to recommend it or what the volume in the stock is or what the chart looks like or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset, put oil in the ground, you're laying out cash now to get more cash back later on. And the question is how much are you going to get, when are you going to get it, and how sure are you? The cash flows aren't printed on a stock certificate. That's the job of the analyst, is to print out, change that stock certificate, which represents an interest in the business, and change that into a bond and say, this is what I think it's going to pay out in the future. Now, when you look at a stock, you look at a bond, so makes United States government bond, it's very easy to tell how much you're going to get back. It says it right on the bond. It says when you get the interest payments, it says when you get the principal. So it's very easy to figure out the value of a bond. It could change tomorrow if interest rates change, but if the cash flows are printed on the bond. You value a business and then you divide by the shares outstanding. But what you have to think about is what kind of a business are you getting into, what are its economic characteristics, who are its competitors, what's management like, all of these things that relate to a business instead of a little ticker symbol. I used to know when I was 11 or 12, the ticker symbols of every company virtually on the New York Stock Exchange. I could mark the boards, it pairs up, but I didn't know anything. I mean, I knew that X was US Steel and G was AT&T and so on, but I didn't know anything. I didn't know what was behind them. So I had to start looking at these little symbols or these little names in the paper as businesses and decide, how do you value a business? What counts? But the real question is, Berkshire has never distributed anything to its shareholders, but its ability to distribute goes up as the value of the businesses we own increases. We can compound it internally. What can we distribute from that 100? If you're going to buy the whole company for $105 billion now, Berkshire selling for, we'll say, $105 or so billion now. Can we distribute enough cash to you soon enough to make it sensible at present interest rates to lay out that cash now? And that's what it gets down to. And if you can't answer that question, you can't buy the stock. You can gamble in the stock if you want to, or your neighbors can buy it. But if you don't answer that question, and I can't answer that for internet companies, for example. There are a lot of companies, there are all kinds of companies I can't answer it for, but I just stay away from those. Most people react the wrong way to stock prices. I mean, they feel good when their stocks go up, they feel bad when they get down. They think the stock market is there to instruct them. But the real question is, I would say that the most important thing over a long period and working with big money is to understand the business. And if you can't answer that question, you can't buy the stock. That's the important thing, and that's what Graham tells you. The market isn't there to instruct you, to tell you anything. The market is there just basically to serve you when you want it to serve you. The beautiful thing about him is that this guy is an alcoholic manic depressive. He is as unsound as they come. He wanders around all day and looks at the crazy things, and he's going to name all kinds of crazy prices. And you don't have to pay any attention to him except when it's to your advantage to do so. If that's once a year, if it's once every 5 years, it's one stock out of 3,000. All you have to do is sit there. You have no moral responsibility to this jerk. You know, I mean, he is naming these numbers. You didn't ask him to, but he's doing it. And all you have to do is pick the one time when he is particularly depressed or particularly manic or particularly drunk or whatever it may be. And the market will be all of those things. And you take advantage of it. And that's what's remarkable about stocks, if you think about it. And Mr. Market is this partner you have in investing. And he's a remarkably obliging partner. This guy comes around every day and he tells you what he'll pay you for your interest in the business or what he'll sell you more at the same price. Nobody ever does that in private business. If you and I owned a gas station together, and I said, every day I want you to come in and offer me your half interest in the station, and I can either buy your half or sell you my half at the same price, and you have to come in every day and do it, you'd be at a terrible disadvantage. And you'd be at a particular disadvantage if you're Mr. Market in the market, because Mr. Market, or a friend of the market who obligingly gives you those figures every day, different figures at the end of the day and the start of the day, but he's naming a price at which you'll either buy or sell. If you look at the high and low on all of these American companies for the last year, you'll see case after case after case where the high is twice below. Now that's for a sound American business, is running along, paying people, selling goods and so on. If you look at farmland 10 miles from here, there's no way in the world over a year that the farmland is going to range in value from X to 2X. It may go from X to 110% of X or vice versa. If you look at an apartment house near here and figures on essentially apartment houses like that over a year, it won't move 10% in a given year. But here are the finest of American businesses, and people just name these numbers that go all over the place. And you don't have to play, except when you want to. That's the important thing, and that's what Graham tells you. The market isn't there to instruct you, to tell you anything. The market is there just basically to serve you when you want it to serve you. Big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you really gotta grab it when they come. Because you're not going to get 500 great opportunities. You would be better off if when you got out of school here, you got a punch card with 20 punches on it. And every financial decision you made, you used up a punch. You get very rich because you'd think through very hard each one of them. You went to a cocktail party and somebody talked about a company, you didn't even understand what they did or couldn't pronounce the name, but they'd made some money last week and another one like it. You wouldn't buy it if you only had 20 punches on that card. The biggest mistakes we've made by far, biggest mistakes I've made by far are mistakes of omission and not commission. I'd had plenty of them. Unless I tell you about them in the annual report, and I resist the temptation sometimes, unless I tell you about them in the annual report, you're not going to know it because it doesn't show up under conventional accounting. But omission is way bigger than commission. It's the things I knew enough to do. They were within my circle of competence, and I was sucking my thumb. And those are the ones that hurt. They don't show up anyplace. I probably cost Berkshire at least $5 billion, for example, by sucking my thumb 20 years ago or close to it when Fannie Mae was having some troubles, and we're going to buy the whole company for practically nothing. And I don't worry about that if it's Microsoft because I don't know it. Because Microsoft isn't in my circle of competence. So I don't have any reason to think I'm entitled to make money out of Microsoft or out of cocoa beans or whatever. But I did know enough to understand Fannie Mae, and I blew it. And that never shows up under conventional accounting. But I know the cost of it. I passed it up. And those are the big mistakes. And the only reason for making investment, laying out money now, is to get more money later on, right? That's what investing is all about. I have an old-fashioned belief that I should expect to make money in things that I understand. And when I say understand, I don't mean understand, what the product does or anything like that. I mean understand what the economics of the business are likely to look like 10 years from now or 20 years from now. I know, in general, what the economics of, say, Wrigley chewing gum will look like 10 years from now. The internet isn't going to change the way people chew gum. It isn't going to change which gum they chew. If you own the chewing gum market in a big way, and you've got Double Mint and Spearmint and Juicy Fruit, those brands will be there 10 years from now. So I can't pinpoint exactly what the numbers are going to look like on Wrigley, but I'm not going to be way off if I try to look forward on something like that. That evaluating that company is within what I call my circle of competence. I understand what they do. I understand the economics of it. I understand the competitive aspects of the business. One of the most important things to remember in stocks, very hard to do, people have all these feelings about. The stock doesn't know you own it. You're sitting there with these certificates for Berkshire. The company doesn't even know you own it. The stock doesn't. It's trading now, and they don't know you own it. The market isn't there to instruct you, to tell you anything. The market is there just basically to serve you when you want it to serve you. No. So it has no feelings about you. You've got all these feelings about it, but it's just part of a business.